In the previous classes, we already discussed what are the four main components of a financial system. The four components are financial markets, financial assets, financial intermediaries, and financial services. So the second and third module is on financial services. We will be looking into detail what are the fund-based financial services in this module. So I've given the syllabus in the PPT, you can go through it. The fund-based financial services like lease financing, hire purchase finance and consumer credit, factoring and forfeiting, bills discounting, housing finance, insurance, venture capital financing will be looked into detail in this module. So let's start with what are financial services. All type of activities that are of financial nature can be termed as financial services. But in the broad sense, when we are discussing about financial services, it includes all activities involved in the transformation of savings into investment. So financial services facilitates mobilization of savings from savers and allocating it to those who are interested in investment. Now, another name for financial services is financial intermediation. So, if the question is what is financial intermediation, then you can write that it is a process by which funds are mobilized from a large number of savers and make them available to all those who are in need of it, and particularly to corporate customers. Usually, those who need funds are corporates because they have got investment plans and they need huge funds, and these funds can be collected from savers. So the services which includes collection of funds from savers and providing it to corporate customers who are in need of it is known as financial services or financial intermediation. Now, before we move on to classification, let's see the situation of how the financial services came to be in the present stage. That is, in the 80s and 70s, the financial services industry was not that strong because it had a lot of uh, drawbacks. Some of the drawbacks was there was too much regulation of the interest rates and the money rates. There was excess control over the securities. The government securities market was not yet developed. Debt instruments were not available. Debt instruments means the debentures, bonds, etc. And there was absence of independent credit rating and credit research agencies. There was not enough financial instruments available. There were not too many companies. There was lacking variety of instruments available. So the financial service industry was not that prominent during that time. But in the 1990s, economic liberalization took place, and after economic liberalization, the financial services industry started developing and getting more attention from investors as well as borrowers. So, the financial service industry can be broadly classified into two: the capital market intermediaries and money market intermediaries. You're already familiar with the term capital market and money market, so you can guess what it means. Capital market intermediaries are those who provide financial services for a long period of time. That is, it includes long-term lending institutions and investment institutions, which mainly provide long-term funds. Money market intermediaries consist of commercial banks, cooperative banks, and other agencies which supply only short-term funds. That is the fund that is settled within a period of 1 year. So short-term funds will be dealt with in the money market sector, and long-term funds will be dealt with in the capital market sector. That is one classification. Another classification is financial services can be classified into traditional activities as well as modern activities. Now, the traditional activities include both fund-based activities and non-fund-based activities. Modern activities can also be classified in the same way, but when we are saying the classification, we'll just say it as traditional activities are classified into fund-based and non-fund-based, and there are modern activities. So what are the traditional activities? We'll go into the fund-based activities. The fund-based activities are dealing in foreign exchange market activities. Some of the fund-based activities are, that is, these institutions where you approach for assistance, they will be helping you to convert your currency into a foreign exchange currency, or they will, if you're giving foreign exchange currency, they will convert it into the home country's currency. So they deal in foreign exchange market activities. Second one is dealing in secondary market activities. That is, they will subscribe to the shares that you have bought from a company, or you can sell these securities, or they're regulating the stock exchange. Sorry, not regulating the stock exchange. They're dealing in secondary market activities. They're facilitating purchasing and selling of securities. They will provide you with funds, that is, they might help you to purchase some securities by letting you borrow funds, and thereby they will deal in secondary market activities. Third one is involvement in lease financing, venture capital, seed capital, etc. Lease financing means equipments will be lent out to you on a hire purchase, not hire, they let you hire some equipments for a certain period of time. That is, you need machinery, but then you do not have funds to purchase that machinery. So what you can do is you can take it for rent. Then you will have to pay rentals to the company. That is a sort of financial service. You can take that machinery for rent for a period of 5 years or 10 years or 15 years. During that period, you will be paying the rent for using that machinery. So instead of purchasing, you're taking it on rent. So lease financing services will be provided. Or if you're starting a company where you're purchasing a lot of machineries and then acting as a company that rents out these assets, then you could get funds for starting that sort of a leasing company, and then also funds will be made available to you. Then venture capital. It is also known as risky capital. Sometimes the question is asked, what is risky capital? So it is just nothing but venture capital. Venture capital is the fund that is provided to highly risky, but those projects which has got high growth potential. It has got high risk as well as high growth potential, and it involves the use of latest technology for those projects or those business ideas which is using latest technology for starting a innovative or a new unique type of business which is highly risky but also has high growth potential. Those firms will be given venture capital. It is called venture capital financing. Third one is seed capital. If a company is starting initially, a certain percentage of the capital, maybe 80% of the capital, can be raised through financial institutions, and the remaining 20% is expected to be contributed by the owner of the business himself, either from his own savings or from the savings of his family, friends, etc. But then there are people who do not even have the capability to raise that 20% of funds which need to be contributed by themselves. In that case, seed capital is offered by certain institutions. That is a 20% which they need to contribute by themselves. This fund will be provided to them. SBI has a seed capital scheme, and the remaining 80% will be provided by other financial institutions. So this is also a type of financial service which is fund based. Fourth one is underwriting of new issues. You're already familiar with the term underwriting. That is, if you're starting a company, you need minimum subscription from the people. When you're issuing shares to the public, at least a minimum number of shares need to be subscribed. The minimum number of shares to be subscribed will be fixed. So the underwriter promises that in case the public does not subscribe to your shares, then I will subscribe to those shares. That is what is known as underwriting. If the public subscribes, then they need not subscribe to the shares. Anyway, we'll have to pay them an underwriting fees for standing as underwriters of new issues. Then the last one is participating in money market instruments like commercial papers, certificate of deposits, treasury bills, etc. Commercial papers are issued by companies for raising extra funds. And there is certificate of deposits and treasury bills. We look into each of that in detail. Next category is non-fund based activities. What are the non-fund based activities? These non-fund based activities has got another name. It is also known as fee-based services. Fee-based services. So what are fee-based services? That is, for the services that they are providing under non-fund based activities, they will charge a fees as return. That is why it has got another name called fee-based services. Now it helps the promoter to market their issues in accordance with the SEBI guidelines. So you have got a business idea, you want to issue shares and raise funds for your capital, but you have got no idea how to do that. You do not know the regulations or the rules of the stock exchange, or what are the Security Exchange Board of India's rules regarding that. So they will be providing you advisory services regarding what type of security to issue, when to issue, what are the rules and what is the procedure to be followed, how to get the required funds from the public through issue of shares. So all those advices will be provided to the promoter. Second one is arrangement with investment institutions for the placement of capital and debt instruments. You want to invest in capital and debt instruments. What are the different types of instruments? Which one is the most safest one? Which one is most risky type of securities? So all that type of advices will be provided to you. Third one is arrangement of funds to clients for meeting project cost and working capital needs. They are not providing you with the funds that you need, but they're pointing out to whom you can approach to raise those funds. That is, which institution is offering moderate rate of interest, which is the most advisable type of loan for you. So that type of assistance will be given to you. If you want requiring the fund for capital or for working capital requirements, where should you approach, what is the procedure that is involved, and what are the different institutions supplying those type of assistance. These kind of advisory services will be provided under the non-fund based activities. Assisting the industries or companies to get clearances from the government. Sometimes you need permissions from the government to start your business. So all type of clearances, like maybe you cannot convert the agricultural land into a business land. So you need to get clearance from the government proving that the land that you're starting your business is not an agricultural land, or you need pollution control clearance. So that type of clearances, licenses, everything will be, they will assist you to get those clearances. So that was the traditional activities. But in the modern day, innovative instruments are required for survival of the financial service industry. So there are various modern activities being involved. So what are the modern activities? First one is providing project advisory services, from preparation of project report to the raising of funds. So they're providing you assistance. You're just a businessman with a new innovative idea. So they will help you to prepare your project report, starting from project report. Project report is nothing but the blueprint of your business idea. It is just a basic report regarding all the details of your project. What is your product? What are the characteristics of your product? Where are you planning to start that business? What is the locational benefits of starting that business in that particular area? What are the raw materials that you require? Who are going to be your suppliers of raw materials? Who is your target customers? What is the amount of capital that you require? What are the type of machineries that you require? What is the time that is going to take for setting up that business? What is the profit that you expect from that business? All these details will be included in your project report. You need your project report when you're approaching financial institutions. You will be handing over your project report to convince them to hand over a loan for you. So under financial services, one of the services they provide is they will assist you in preparing your project report so that you can raise the funds that is necessary for starting your business. Second one is planning and assisting for mergers and acquisitions. You have already started your business. Now you would like to expand it. So you can join with another existing company by through merger, or you could acquire that business. That is, you're buying another existing company, and that all sort of advices regarding that will be provided. Third one is helps in capital restructuring of companies. What do you mean by capital restructuring? When we are starting a company, we have to raise funds either from our own savings. That is, we could use our own funds or you could use borrowed funds. So the debt and equity, when you're using own funds, it is known as equity, and when you're using borrowed funds, it is known as debt. So what should be the percentage of debt in your business? What should be the percentage of equity in your business? What should be the ratio between the borrowed funds and the own funds? So sometimes when the company is going through a crisis, you might want to change that proportion of debt and equity. That is known as capital restructuring. Maybe you would like to reduce the percentage of debt in your capital. Then you'll pay off to your creditors and settle them so that the percentage of debt comes down. Or you might want to increase your equity. So by issuing new shares. So there is a change in the proportion of the equity and debt. And these financial services industry will assist you in restructuring the capital of the company. Fourth one is act as a trustee to debenture holders. See, debenture holders are those who lend money to the business for a fixed period of time, and they are assured a fixed rate of interest during that period of time. And then the amount that they borrowed from the debenture holders will be returned back. That is maybe for a period of 5 years or 10 years, that amount will be kept in the business and utilized, and then that amount will be returned. During that 5 years, interest need to be paid whether the company has profit or not. Sometimes it is secured by assets. That is, if there is any default in payment of interest, then the debenture holders can sell off these assets and get back the money. Sometimes it is unsecured. Anyway, the debenture holders do not have voting rights. So to make them feel a bit more confident and secured, trustees will be there for the debenture holders. Trustees are those who act on behalf of the debenture holders. That is, they ensure that all the interest of the debenture holder is protected. That is, the company does not move against the interests of the debenture holders. So financial service industry, sometimes the intermediaries in the financial services, they will act as trustees to debenture holders. They are the intermediaries between the company and the debenture holder. Next one is managing the portfolio of large public sector corporations. Portfolio means nothing but the combination of securities. So if you have funds, you could invest in different type of securities. You could invest in shares, you could invest in debentures, you could invest in bonds, you could invest in government securities. So how much amount should be invested in what type of security? That is what a portfolio deals with. So portfolio management is of large public sector corporations are dealt with under the modern activities. That is, the public sector corporations will be given advice on where to invest their funds, in which industry, in which shares, in which type of securities, for how long should they invest. So all these advices will be provided. Then recommending changes in the structure and style of management. Maybe for an improvement or betterment, a change in style of management is required, or a change in the structure of the management is required. Then that type of advices will be provided. Then undertake risk management services like insurance services and buyback options. Sometimes they will provide you an insurance cover to protect you from unforeseen risk. Or there's a buyback option where when you invest funds, they will promise to buy back the shares of the company after investing the funds. So buyback option is also provided. Then guiding clients in the selection of optimum debt equity mix. So sometimes people do not know what percentage of debt should be included in their business, what percentage of equity should be included in their business. So that type of advice will be given. Capital restructuring comes when they have already started their company with a particular debt equity mix, but then the company is facing a crisis, then they need to restructure the mix. That is where capital restructuring comes. This point says that they will help you in determining the debt equity mix when you're starting a company. Next one is undertaking clear, because going back to the same point that I was explaining right now. See, debt equity mix is important because if you're using debt, too much debt in your company, then whether the company earns profit or not, whether the company has got an income or not, debt means you'll have to pay a fixed rate of interest. But if it's equity, you need to make payments only if the company has got profit. But the problem, if there is too many owners, too much of equity funds, then the earning per share will go down. That is, when you're splitting the profit, you'll have to split it between a huge number of people. So the amount that a particular person gets will be very less. So they'll prefer to have only 2 or 3 owners, and then they will want to use debt in their business. But then if there's too much debt, it's a problem. If there's too much equity, there's a problem. So you need to find a optimum mix. Next point, undertaking clearing services, registration, transfer, safe custody of securities, collection of income on securities, etc. It has got everything to do with the capital market where you're investing your securities for a long time. So how do you get clearances for the securities? How do you register the securities? How do you transfer it to another person? How to keep custody of the securities, collection of income on securities, all these will be taken care of by the financial service industry. Last one, it promotes credit rating agencies. Who are credit rating agencies? Credit rating agencies are those who give a rating to the company. That is, if you're an investor and you do not know how a company is performing, then you will be hesitant to invest in it. So what credit rating agencies do is that they will assess the performance of the companies over the previous few years, and they will give it a rating. If there is no outstanding debts, if there's been consistent rate of profit for the company over the past years, then they will give them a grade, maybe a AAA or a A++. So when the investor is planning to invest in a company, they will check what is the rating given by the credit rating agency. CRISIL, ICRA are all examples of credit rating agencies of India, but abroad there are international credit rating agencies like Standard and Poor, Moody's Investment, etc. So all these credit rating agencies will give a rating for the companies. If you get a good rating, they are independent outsiders, so they can be impartial when they are giving a rating. They are not someone from inside the company. They are outsiders who will rate different companies, so they will be impartial and independent when they are giving a rating. If the company has got a good rating from the credit rating agencies, then it will be easier for them to raise funds. So credit rating agencies will be promoted in financial services industry. So these are the modern activities which are being carried out under the name of financial services. Now you need to be familiar with one more term. What is financial engineering? See, the business environment is a dynamic one. It keeps on changing. New challenges keep on coming up. To survive in this environment, the financial services also need to keep on changing. That is, the instruments, financial instruments which is available need to be updated. The services that you're providing need to be modernized daily. You have to provide different type of new services to the customers. The client need to be kept happy. So financial engineering is the design, development and implementation of innovative financial instruments and processes, and the formulation of creative solutions to problems in finance. So if there is a question regarding what is financial engineering, you should be familiar with the explanation. It is the design, development and implementation of innovative financial instruments and processes, and the formulation of creative solutions to problems in finance. Coming up with new instruments, coming up with new solutions to new problems is known as financial engineering. So we'll discuss each of the fund-based services in detail from the next class onwards. This was just an introduction on what is financial services. Thank you.